the Bank of Canada's policies and how they're trying to circumvent and limit inflation. As we all know, inflation was 7.7 up in May. Now it's gone up to 8.1 for June. That's the recent news that we've had. Bank of Canada increased their rates by 1 full basis point, 100 basis points, 1 full percent a few weeks ago, which also caused a lot of stir in the market, which is, in a good way to limit inflation. So we're going to be talking about all of those things today, but we'll give everyone a few more minutes to join in. Also, another very important reminder: next Saturday session, Zoom session, we're going to be holding it in conjunction with RBC. An economist from RBC is going to be coming by. More information on that will be shared with you this following week, but do look forward to next week's session. Again, next week's session is going to be a lot more in depth of what we're going to be discussing today, and overall definitely beneficial for all of us. All right, it's 9:34. Let's give a few more minutes and then we can begin. We have 38 participants online right now. That's good. I think the common message just went out as well, so that should bring a lot more individuals in the group. All right, so I think we have over 40 people. I think it's a good time to start. Silvana should be joining us shortly as well. So today's session, today's topic, it was all about, mainly about the interest rates, what's happening in the market, what do we need to know, understanding interest rates, what the Bank of Canada's position is, how they're trying to limit inflation, what inflation is, where we're at with all of that. Kind of, the main topic in our economy, in the news right now, and everything that's happening in the economy. Let's just say the simple way we can start out this today's session. We'll be talking about what is interest rate at the end of the day, right? Now everyone knows what interest rate is. It's simply the interest is the cost of money, right? And basically what is the rate of interest, and that is the cost someone. The rate of interest is the cost of using someone else's money. So let it be. So in two ways of looking. Let me just mute that individual, add a few others in. So again, what is interest rate? Interest rate, simply the cost of money. The rate of interest is the cost of using someone else's money. So when it comes to interest rates, the two main things to look at is that in one direction there are the borrowers, and on the other side there are the lenders, the ones that are lending out the money in order to obtain interest, and the borrowers are there to be borrowing the funds and to pay interest. Simply, if we look at it in the mortgage sense, the banks are lending out the mortgage, and the borrowers who are purchasing a property are obtaining a mortgage and paying the interest for the bank. So what are some of the effects of interest rate? How does the rate of interest get calculated? All depends on what we're talking about. There's many factors to it. So some of the things we'll be talking about is the rate of inflation, and also things that which increases the rate of interest is what's happening in across what Bank of Canada is looking at. The length of time that we're holding funds or we're obtaining a mortgage. So some changes for interest rates come based on the time of the time that we borrow funds. Simply, if we look at mortgages, if we get a mortgage with a 1-year term versus a 10-year term, or if we get a mortgage of a 5-year fixed rate versus a 10-year fixed rate, the difference in rates for that is due to the monetary policies, and also how much interest can be charged for a certain period of time. 1 second, I'm just going to add a few more people into the meeting. Perfect. Okay, so before we go deep into it, let's talk about the Bank of Canada. What is Bank of Canada's main role? Who is Bank of Canada, and etc. Right? So Bank of Canada, as everyone knows, is a government-operated bank that serves as a central bank for Canada. Bank of Canada is basically the nation's official bank, and it's been in creation since 1934. And their main goal is to promote the economic and financial welfare of Canada. That's based on the Bank of Canada Act. Again, with all the recent news in the industry about what the increases of rates and etc., Bank of Canada has been officially, looks like Salvana's on the line as well. Perfect. So Bank of Canada's role would be to overall look after the social welfare of the Canadian banking system, and also to promote economic and financial welfare. So if we're looking at the recent news articles and also what the Bank of Canada is doing, recently we've been knowing that Bank of Canada has been increasing interest rates over some time. Early 2020, COVID hit. What did the Bank of Canada do? They decreased interest rates 3 times in the month of March. Now, there are the several world issues that has caused a world financial issue. And also what the Bank of Canada now is doing for finances here in Canada, they started increasing interest rates. That we started seeing as early as March of this year. So in terms of us, we're in the real estate industry. So what we're seeing is many of the clients who got mortgages previously, who from 2020 onwards were enjoying a lot of low rates. Now we're starting to see the interest rates rise heavily, which brings up a lot of questions about how our clients are seeing the differences and how they're reacting to it. Main thing I want to bring up when it comes to interest rates is how it affects us and what it means for us. When it comes to the recent rates going up, as far as 2 weeks ago, we've seen on Wednesday, Bank of Canada increases the rate by 1 basis point, 1%. Now we're sitting at a prime rate for banks at 4.7%. With the prime rate being at 4.7, we're seeing a lot of increases in the interest rates from March till right now. Banks are sitting at an average interest rate on the variable side right now at around 4.4%. When last year or the year before, we were seeing rates at 1%. Fixed rates are around 5.5% right now. Again, if we look at rates 2 years ago, we were sitting at rates around 2.1 or even 1.85, 1.95 for 5-year fixed rates. So again, massive change in that. Of course, our consumers, our clients need to understand, and also we need to understand how that works. What I can say about the interest rates that we're seeing from the past and right now is there's a considerable difference that consumers are paying, depending on which lender they have a mortgage with. Majority of the lenders we have in Canada are the top 5. We usually refer to as the top 5 or top 6, which includes the normal banks: TD, RBC, BMO, CIBC, Scotia, National Bank of Canada. The one thing that many people may not know is that majority of the banks, they don't, when the Bank of Canada's interest rates or bond rates go up, it usually doesn't affect anyone that has fixed rates. It shouldn't affect anyone that has fixed rates. If it's a 1-year fix or a 5-year fix, your rate that you initially got at the start of the contract would be exactly the same. The monthly payments would be exactly the same, regardless of the interest component and the principal component. However, if you have a variable rate, then 100% there is an increase in the interest component that you're paying. Let's just say your monthly payment is $4,000, while your mortgage, variable mortgage, if the rates go up, if the Bank of Canada and also the bank, the institution that you're with, if they're increasing rates, then of course the monthly payment that you're paying on that payment of $4,000, the interest component will be higher and the principal component will be lower. Now, there are a few banks, one mainly Scotiabank. What they do for variable rates is that they don't wait for a trigger point to take place. A trigger point is basically when in a mortgage contract, let's just say you're paying $4,000 a month for your mortgage payment. There's something called the trigger point. Whenever the interest rates goes high enough that you won't be able to pay enough interest for the term that you're on. Let's just say you have a 30-year amortized mortgage on a five-year term. If the interest rates goes up to a certain point, there'll be a point where you're not going to be paying any principal and you're only paying interest. When the interest rates go high enough to hit that trigger point, what banks do is that they start telling the clients, whoever has a variable mortgage, that your mortgage payment is going to go up as well. So banks such as Scotiabank, they don't wait for trigger point to take place. If there's any clients that have a Scotiabank mortgage and you're on a variable term, what's going to be happening is you're going to be paying that additional payment upfront when you have a variable. So few clients of mine that are with Scotiabank, if their mortgage payment was actually, let me share the screen and show this to you right now. Perfect. You can see the screen over here. So if you have $1 million mortgage and your interest rate at one point was 2%, your monthly mortgage is going to be $3,692. Now, the minimum increase that we've been seeing by the Bank of Canada recently is by 0.25. So let's increase this rate by 0.25. And what we get is $3,817 as your new monthly payment. For any clients that have a Scotiabank mortgage, every time the Bank of Canada increases interest rate, the price per month is going up by $125. $125 for every for every 100,000 that you borrow. So in this case, for every million that is being borrowed. So in this case, depending on which lender that you're with, who you have a mortgage with, you're going to be seeing an increase. Scotiabank clients sees it right away. Certain banks, they have to wait until the trigger point hits. We've been getting a lot of information from TD Bank saying that they're going to be contacting their clients, whoever has mortgages with TD, they're going to be contacting their clients very soon to let them know that their variable rate mortgage itself, the monthly rate, is going to be going up. So that is something that everyone should know. Why? Because it's going to be affecting clients and the amount of mortgages that they have right now. Also, with all the rates going up and et cetera, and all the other economic issues, we're seeing, the home prices come down as well. That, again, Rashani is here. She's going to be talking about some of the, difficult changes, the difficulties that clients are facing right now, especially when it comes to closing properties in today's time. But what we're seeing on our side is that the qualification to get to obtain a mortgage is also going higher. Not just the interest rates, but also the qualifying rate. Even though the qualifying rate was decreased a few months ago to assist with getting a mortgage, at the same time, on the B side with alternative lending, we're seeing that the banks have now come up with 2% higher is what we need to qualify clients with. Now, those that don't know what qualifying rates are, OFC, basically the superintendent for all financial institutions. And back in 2018, January 1st, they came out stating that whoever's obtaining a mortgage must be qualified at a higher rate than what you're paying already. So right now, if you're getting if you're getting a mortgage with a 2% rate, you're not being qualified at 2%. You're being qualified at 5.79, approximately in that range. So whenever the interest rates goes up to a rate of 5.79, you'll still be able to pay that mortgage. Right now, the qualifying rate is around 5.25. So previously, you would only qualify up to that amount. Now, what's happening is you don't qualify at 5.25 on the alternative B-side lending. You're qualifying at 2% higher. What that means is right now you need an average income of around $240,000 in order to qualify for $750,000 to $1 million mortgage. 240, 220, 250,000 income, household income is what we need to show in order to get everyone qualified. So that's one of the issues that we're facing right now, which in turn causes approval rates to be going down. Also, what we're seeing is renewal. In average, 17% of Canadians renew their mortgage every year. And what we're seeing with that is whoever is renewing their mortgages at this moment in time, they're going to be paying much higher. What banks are doing is the rates that are being offered right now is a tad bit lower when it comes to renewal. You've already tied in with the bank. There's an incentive there. So the rates that you'll get when you're renewing or even through early renewal would be a better rate than you shopping around at the moment for new rates. So my advice is, of course, this lowers business on the mortgage brokers world, but it is probably beneficial if you stay with the lenders you have right now if you want to renew at a lower rate. If you start shopping around for better rates, it's most likely unlikely that you will probably find a better rate than what your bank is already offering you. Again, OFSI already came out with they already had measures put in place for issues such as inflation. Or wherever the Bank of Canada increases rates. As I said, 2018, January 1st, there was a mandatory policy set forth for every banks to follow, and that is the qualifying rate. So from 2018, people are already being approved based on an interest rate of 5.79. So that means if the interest rate goes up to 5.79, the qualification is for that amount. So that means you should be able to afford if the rates go up to 5.79. At the moment, on the A-side banks, with the A-side banks, the average interest rate on a 5-year fix is sitting around 5.4, 5.5. So we're still under that qualified amount. So in the eyes of the bank or the government, individuals right now should still be able to afford their mortgage payments without any issues. Why? Because at the time of mortgage approval and in order to get the mortgage approved, you already showed enough income to cover certain debt ratios, right? So we're seeing a lot of changes in that right now. Why? Because majority of the individuals that got approved for mortgages really weren't making that enough income to qualify for it. So we have some clients that are unable to afford keeping up with payments. Again, it's quite common, but at the end of the day, default rates are extremely low, still continuing to be extremely low. Another few things that I can tell you about the interest rates hikes and how it's affecting clients right now is the individuals that are trying to refinance. This is my own recommendation and also a few other professional recommendations from individuals in the industry. Ron Butler from Butler Mortgages, a veteran in the mortgage community. When I was out golfing with Canadian mortgage professionals a month earlier, I met Ron there, and we had quite a nice discussion. And what he was stating is that if anyone is trying to refinance and pull out equity from their home, it's probably the worst time to do that. The reason is whatever first mortgage you have with an institutional lender with the top 5, your interest rates are probably lower than 3%. In today's time, it's probably not the best idea to refinance out of a good mortgage rate you have at the moment. If you're contracted for another 3 years, 4 years, and you need to pull out funds either for a purchase or for renovation purposes, it's probably better if you go into the alternative lending world spectrum. So obtaining a private mortgage or getting a private HELOC is probably the best aspect of you trying to pull out equity than rather, leaving $1 million mortgage with RBC that you have for 2.95 and now trying to refinance that out with another institutional lender for a rate of 5.5% plus. Now, that's probably something that you shouldn't do and wouldn't want to do in today's time. A few other discussions about what's happening in the mortgage industry, especially with the increase in rates. Of course, everyone knows appraisals on homes are coming very, very low in certain areas. In some areas, it's perfectly fine. Again, if you do a mortgage right now that is insured with less than 20% down payment, I'm hearing and I'm seeing that appraisals through the banks, whenever it's going through CMHC, Canada Guarantee, or Sagan, used to be called Genworth, the appraisals are coming in line. It's a desktop appraisal that gets done. And also the bank always, since they're protected through insurers, the appraisal is a tad bit fair. So we're seeing fairness when it comes to appraisal, not by the appraisal company, but overall, whenever it's an insured deal. Now, we're seeing a lot of individuals not getting approved with 5% or 10% down, where everyone's putting, majority of the individuals are getting a conventional mortgage with 20% down. Whenever you're putting 20% down and getting a normal mortgage for a purchase or a refinance, an appraisal has to be done. It's a physical appraisal. There's an appraiser, third party company that goes over to the property, assesses it. And the bank's policy right now is, of course, the financial outlook and the outlook in the real estate industry is that the prices are continuing to decrease slowly, as we've seen for the last 4 or 5 months. So when appraisals do come out with their projected value, it's definitely lower than if you purchased a property a few months ago. Those APSs that we've seen that was signed in March, April, May, when the closing date is coming and appraisals are coming now, it's definitely lower. So what I can tell you about individuals who are getting lower appraised amounts, it's always best to, Salvana will touch on this, but in situations like this, you have to make sure you somehow do close the deal. It's in your best interest to, of course, close the deal. Salvana will probably talk about certain measures you can put into place to circumvent that in case you come across that issue with lower appraisals. And Rishani will touch up on that topic as well. But that's about it on my end. I know Salvana's here and he wanted to share a few things with you as well. So we'll probably give him a time to come on board.
Good morning, Jim. I don't want to start with apology, but I came late today. Our office agents, Blue Diamond Group, was doing the coffee and other things in the Varasiddhi Vinayakar temple. Then I participate that one, and Kannan and Rishani is ready on board. That time was started this meeting with you guys. Okay. Yes, I'm going to continue this one. What I can tell you here, Kana, if you have time, please come and check my laptop, Kana. I'm doing the phone right now. My laptop is getting some issues.
Sure.
One second. If you can, please come in. All right. What I can tell you guys, yes, we know what's going on with the appraisal. Appraisal is an issue. But as a broker record and as a salesperson in my office, as a broker record, my part to tell you guys how we can close the transaction. What are the options we have? But we can try to close the transaction even though appraisal value comes lower. That's been for the few closing techniques if the appraisal value come lower. That's the way I like to start a bit. Number one, what we can ask, we can ask for the vendor take back mortgage. There are so many cases. Agents are doing asking the vendor take back for the sellers. What I can see in the office, yes, that's happening. So most of the sellers are, I can't use the word most of the sellers are willing to give the vendor take back mortgage. The reason market last 3 months, we can see the market adjustment, market came down. when the market came down a little bit, then they already have a agreement in place. In that case, they wanted to close the transaction. When they want to close the transaction, they already making money right now. Sellers, whoever listing the property, they are making money. In this case, they have extra money. All right, I'm switching it to my laptop right now from the phone, guys. I'm sorry. Sometimes technology. All right. Everybody can hear me?
Yep, it's all good.
Okay. But we can do, the sellers are selling it right now with a higher price as whatever the price they bought it. In this case, sellers have the phone.
Yep.
Sellers have chunk of money. The sellers have some of money they are making from the sale of the property. In this situation, what is happening? If we ask for the when to take back mortgage, just many cases they are giving the when to take back mortgage. That's one of the ways we can try to close the transaction. Second thing, you can try private mortgages. It's an issue because some private mortgage companies also looking for the appraisal and hard to register the deal, but the money short come for the appraisal value. But at the same time, still you can try out. For the private mortgages, try to close a transaction, and you can try other banks. Maybe the appraisal value based on the lender's instruction to the appraisal company. For example, as for my knowledge, A lenders are much easier than the private lenders. The private lenders are what happening. They are giving their instruction to the appraisal companies. Just go for the strict appraisal. In that case, you may see some the difference on it. Then you can try those ones. Different banks with different appraisal company go and do the appraisal. And the next one I can say, request the bank for the full appraisal rather than the drive-through appraisal. The full appraisal always they go inside. When they go inside the property, they try to give. They can see the property clearly. Maybe you can do the staging before they go. Something like that, you can do it, then that will push the property up. Or else if you have a neighbor in the street, if anybody in the neighbors in the street, just put the property, list the property much higher than this property. In that case, that's an extra boost for the appraisal company. When they go, they have some support to bring the appraisal up. There are a few things we can do it. That's what I can say. Then other choice also we have. There are some cases it may work out. If the buyers have a good income people, you can go with less than 20% for the CMSCH mortgage. If you go for a less than 20% with the CMSCH mortgage, there's a chance you can get the high ratio mortgage. The high ratio mortgages is easy to qualify than the regular mortgage. In that case, sometimes if you go with less than 20% value, you may qualify for those ones. What I am saying is a closing techniques if the appraisal value come down. The problem I have, some agents are calling me the daily basis and saying appraisal value come lower, then the buyer is not in default. We're going to cancel the deal. First, our real estate agent, we have to clear our mind to know we already have a transaction written in the agreement of purchase and sale without any condition, without any appraisal as a concept. In that case, there is no reason we had to leave the transaction. Okay, before I pass it to Rishani, I have some questions. Some agent asked me the question. I'm going to go through the question for those ones. After that one, we could call. One agent called me and asked me, about the variable rate, because this season is a mortgage season. They asked me what is the difference between the open variable and the closed variable. I'm not really sure Kanna covered this one or not, but at the same time, what is the open variable and closed variable? There are things, guys. A variable rate. When you are getting the variable rate, we all know the variable rate. The variable rate interest in the variable rate. The rate is varies. Rate is varies based on the overnight interest rate and the bank prime rate. But the term is closed. The term means you are getting 3 years term or 5 years term. That's the 5 years you have to stick with the bank. That's the 3 years you have to stick with the bank. That's what the variable mortgages. Variable mortgages, whatever we say, always close mortgage. Close mortgage for the term. And the rate is the one varies based on the bank prime rate. And the same person sent me other question. How much is the discharge penalty for the variable mortgage and the fixed mortgages? Fixed mortgages, for example, you are getting the fixed mortgage right now. Fixed mortgage right now is a going rate, or what are the rate you are getting it right now? For example, say around 4.25% you are getting it. And the 5 years rate from 2022 to 2027. And one year, after 1 year, you're going to discharge the mortgage. If it is a fixed mortgage, what will happen? They will look at today's current rate. For example, next year, they already have 5 years mortgage. Next year, 2023, July, they want to discharge the mortgage and they don't sell the house. But the banks look at it, in my point of view, they will look at the rate, 2023 July, how much is the rate is going on? What is the rate you locked in? The difference between those one, bank can get the benefit if you keep the mortgage until 5 years. That's the difference they will charge you as a penalty. In my experience, I seen only up to 40,000 penalties. There are some cases. That's the highest I've seen. Maybe Kanna might know so many other situations for the mortgage industry. The variable mortgage, whatever is there, they charge only 3 months interest. That's a minimum interest. That's a minimum interest they can charge. The interest adjustment 3 months. It depends on the bank. If you lock it 5 years and you want to go faster, sometimes they may charge more or less. I cannot control those ones, but it's a basic knowledge. The fixed mortgages, they go for the different interest. Today interest rather than you are locked in interest. But based on that one, based on your term, they will charge you the penalty, or the penalty is much higher, and the variable rate, the penalties are lower. Another question agent asked me, he received the offer, and the offer expires on the 3 p.m. on last Saturday. 3 p.m. on the last Saturday, the irrevocable time expired, and he couldn't able to communicate with the salesperson, and finally he talked to the salesperson Saturday at 7 o'clock after offer expiry, and agent said, yes, I'm going to send you the sign back. Then he called me and asked me, Silvana, what they can do the offer is expired. My answer, I'm a broker. I'm always say, I'm telling as a real estate agent to make the transaction. I'm not the lawyer to say, the legal point of view, don't leave the clauses. I always say, how can you make the transaction and make your money? For example, you give the offer to the seller. Seller, 3 o'clock expiring. Seller, that's been office. Technically, the offer is expired. Offer expired after 3 o'clock. But at the same time, seller already signed back before 3, and the agent keeping it in their file and not answering the phone call. Your offer is still valid. You know what I'm talking about. In that case, even though after offer expiry, even the salesperson send it to you, who is taking the listing salesperson is in charge. He's the one taking the responsibilities for the seller sign back. In that case, if you receive after the expiry date, after the offer expired in the night time, and if they, as long as they change the expiry date for the next day or day after, that's been the time you receive, you are receiving as a new offer from the seller. Sign back means you are offering to the seller. Seller is offering back to you. In that case, seller is offering you a new offer. That means sign back means seller signing back That means seller is sending you a new offer in your form. Technically, it's a new offer. In that case, offer is valid. This question I got last week. And there's another question somebody asked me, Silvana, can you explain to me the terminology of the what is overnight interest rate, what is prime rate, and what is the mortgage rate, what is variable rate, what is fixed rate? Overnight interest rate. Overnight interest rate means, as you know, the Bank of Canada started in Canada. Canada is a Canadian banking system developed 100 years ago during the after 19th century, and during the after the 1934 government of Canada, the Parliament approved and they started the Bank of Canada. I was shocked actually when I see this one, 1934. That's not too far away, because I thought it's in England banks we already seen it as the 17th century and 18th century. But 1974 is one of the number I seen it in the Google. In case if I am wrong, don't blame me, guys. That's what I seen it. 1934, the government, the Bank of our Parliament is approved, and they started for the they started for the Bank of Canada started 1934. After they started 1974, 1938, they made some amendments, and the Bank of Canada wanted to run independently, not getting too much interference with the government of Canada, and there are certain issues still going on. Government is controlling the Bank of Canada or not. There are so many gray areas are there. Okay, what I can say. We need an organization to control all the banks and everything. That's called Bank of Canada, and Bank of Canada set up the interest rate, overnight interest rate. That means, what is the overnight interest rate means? We have so many banks. We have major banks, 5-6 banks. We already know, and they all have money. The banks to bank overnight interest rate means one Canadian bank to lend the money to other Canadian bank. That's called overnight interest rate. That interest rate is the one going to decide so many factors, but exactly that rate is the one Royal Bank give the money to Scotia Bank, or Scotia Bank borrow the money from TD Bank. That's called the overnight interest rate for the bank. Bank prime rate. Bank prime rate is the bank setting up their own prime rate based on their balance sheet. Based on the balance sheet, how much balance sheet money we have, how much where are we going to invest the money, what sectors we going to invest the money, and what are the lending ratios we going to keep it based on the bond market, bond trading and everything. The major banks, they are setting their own prime rate. Prime rate is not set up by the government of Canada. Prime rate is not set up by the Parliament. But at the same time, they had to follow the National Housing Act under the mortgage side, certain mortgage act, and setting up the rate. But that's a bank prime rate. Bank prime rate can be changed from Royal Bank to Scotia Bank to TD Bank. As for my knowledge, again, that's mean bank. Maybe the central bank, the Bank of Canada's interest rate can be 2.25, but the same time the Royal Bank set up their own prime rate for 4.5. Kana, what is the prime rate today for the banks?
4.7.
4.7.
4.7 is the bank prime rate right now. Almost all top 6 banks keep it exactly the same. There's only one outlier, which is TD. They keep their prime rate 0.15 higher, so they're at 4.85.
Perfect. Thank you, Hannah. The bank prime rate is owned by the major banks. They are setting up the same rate because they want to competition each other. They don't want somebody based on other things. As like Hannah, thank you very much for the information you gave me. The TD Bank's point at this moment, a little bit more much higher. That's a bank prime rate. And after they set the bank prime rate now 4.7 and 4.8 for the different bank, based on the the value of the bank and dealing with bank, how many products you have and everything, they go for a discounting rate and everything. That I'm not touching that one. The relationship between the bank, they give you the variable, give you the discount, or else they add prime plus also, they may go for it. Okay, that's the way they work on it. And fixed rate and the variable rate, again, that's also set up by the each and every banks. They're setting up what's my fixed rate, what's my variable rate. Based on that one, they are adjusting. Again, the question somebody asked me, variable rate. Yes, variable rate. The rates are varies, and the term is fixed. Fixed mortgage, both are fixed. Open mortgage means just it's an open, but much higher rate. Much higher rate, almost like a private mortgages, much higher rate. I saw it sometime. One of the paperwork I saw it from the Scotia Bank, because the mortgage expired and mortgage term expired and they didn't renew it. They make it as an open. Is around 9.5 or something like that. Am I right, Karna?
Yeah. So I feel that many people, good topic you brought up, because I feel that many people get confused over the open and closed terms. As Salvana said, that's based on the contract you have with them. So you could have a 5-year fixed rate, and that 5-year fixed rate could be a closed term or an open term. Or you could have a 5-year variable rate with a closed term or an open term. Majority of us, when we get mortgages, we're always getting a closed term, right? Because the rates are lower. And also it ties us into that contract for that amount of years. Open term, basically the easiest way to differentiate open or closed is an open term is at a higher interest, right? Let it be variable or fixed that you're getting. An open term means you can leave that contract at any point in time without any penalties. That's the simple answer to it. An open term is at a higher interest and there's no penalty to leave that mortgage. So you can pay off the mortgage the next minute, or you can refinance out to another institution and not worry about paying any discharge penalties. Closed terms, again, if you have a variable close, it is usually industry average. Industry norm is 3 months interest penalty. If it's a fixed closed term, it is the interest component up until the end of the term. That's simply it.
Okay, Rishani is here. She is waiting to give you guys some advice. Rishani, you can come, you can unmute, and you can start your advice to us.
Hi, everyone. Thank you for having me on the call today. So just before I get started on the actual topic for today, for protecting you guys in today's legal market, since I have everyone's attention, I just want to take a quick minute to just let you guys know, this has nothing to do with today's presentation, but with regards to assignment sales, there's actually been a change in the law. So I just want to give everyone a heads up since I have everyone's attention. So basically, when you do an assignment, so that means you purchase a property from a builder and then you sell it before you close a transaction. So for any assignment sales that anyone entered into before May 7th, 2022, the current GST HST rule was that it could be taxable or it could be exempt. So if it was, if the purpose of it was to possibly resell their interest in the property, then it would have been taxable. But otherwise, if they had purchased it with the intention of living in there, then it could have been exempt. But what happened was from May 7th onwards, what they've now said is that all assignment sales in relation to newly constructed or substantially renovated residential housing is taxable. So in the event that you assign the property, all of it is now taxable. So I've had a couple of agents ask me this, just wanted to quickly let everyone know. So now if you want to assign that property prior to closing it, it will be taxable. So if you guys are, when you're drafting your agreement of purchase and sales to clients and you guys are doing the assignment agreement, just make sure the current HST clause that you guys have in the agreement, just amend it to say that you've explained to the clients that this will be taxable so that they don't come back at you later and say anything in relation to, oh, you didn't tell me, now I have to pay this, you pay the cost, things like that. Just make sure to just amend the current clause, because currently it says if taxable, they're subject to taxes. Just say you advise them that taxes on any assignment sales, it will be taxable, any profits will be taxable, and that you clearly document the agreement and you even let them know by email as well. So I just wanted to let everyone know that quickly. Back to the actual topic in terms of today's markets, and as my dad and Kannan and both mentioned, the appraisal values have gone down in the last several months, and this has caused issues with a lot of people. Right now, even as I talk to you guys, I just got an email from my client saying, I already borrowed $97,000 from friends, I borrowed another $50,000, I'm still short $175,000, I don't need to close a deal. So I've got to now go back and write to him and say, no, that's not how the law works. But anyhow, just to give you guys a summary of what's been going on, yes, appraisal values have been coming down. From the legal side, from the lawyer's perspective of things, I wanted to just let you guys all know. So people have been asking me, what happens to the deposit itself when a deal doesn't close? If the vendor suffered no damages, can they take my deposit? These are all worst case scenarios for when you default, which is why, as my dad and Kanan have both said, always try to close the deal. So just so you guys know, when a purchaser fails to close a transaction, the deposit will be forfeited, right? So even if it's being held in the brokerage's account and they apply to court, the deposit will almost always be forfeited. This is true even if the vendor suffered no damages. So even if they suffered no loss, even if they still sold for higher, they can still keep the deposit they want to. So when a purchaser repudiates the agreement, they fail to close the transaction, the deposit is forfeited even without proof. The only way a deposit will not be forfeited is if you apply. So if you had a deposit that may have been disproportionate. So for some reason, if it was like $1 million property and you gave a deposit over 500,000 and then you couldn't close a deal, you can apply for something what's called a urgent motion from relief of forfeiture of deposit. So this is where you're saying that it's unconscionable for them to actually take your deposit because you made such a big proportion of your purchase price in the deposit and then you couldn't close. Maybe in that case, you might be able to argue something, but other than that, even if it's a 20, we've seen cases where even if it's a 20% deposit of the purchase price, then there's not much you can do. So it is always better to close a transaction. And if you fail to actually close a deal, how can you get sued and what does mitigation actually mean? So what this means is that the seller, so in the event a purchaser, let's say their appraisal comes down and they say, look, I just don't have the money, I can't close the deal. So if that happens, right, the seller can actually sue you for almost all the costs associated with reselling the property. So basically the position is to put the seller back in the place they would have been if they completed the contract with you. So that means you can get, like, if you end up suing them, you can actually get awarded damages for staging, legal fees, carrying costs, interest on your first mortgage, any bridge loans, any personal loans, anything you had to do in order to resell that property to someone else, you can do it. And most importantly, if you don't close on a deal, what happens is the seller can actually sue you between the difference between your price and the new price that they sold it for. So if they originally sold it to you for, let's say, $1,550 and they resold it for $1,200, they can actually sue you for the entire difference plus everything else that I've already mentioned. So usually what happens is a lot of people come and tell me, they say, okay, my appraisal value came down. The seller has to renegotiate the price with me. I need a price reduction because otherwise I can't close a deal. And then they'll always say, okay, the seller needs to mitigate the situation. You know, the market came down and if I go to court, I'm going to say the seller didn't even try. They failed to mitigate their damages. So I always go back and explain to them what the word mitigate actually means, right? So this means that when the courts look at what you do to mitigate, that's only after you've actually defaulted on the agreement. So for example, if you had a contract with somebody for $1,550 and then you didn't close at all and then you resold to somebody else, the courts will look at what you did after they failed to close the deal. So for example, staging, putting proper efforts to resell the property, not just taking the first offer that comes because you said, okay, I can just sue the person for the difference. That's what they're talking about when they say mitigation. It's everything after you close, not in the middle of the transaction. So it's always a point that confuses people because they always think that, like, okay, you don't have to actually accept a lower offer from the seller. In practical terms, it is everybody should close a deal. So in this given market, you may want to exercise that option. But the duty to mitigate doesn't actually mean that the vendor has to accept a lower offer from the defaulting purchaser from what they originally agreed to. So they don't have an obligation to accept a reduced offer by a buyer who fails to close in order to mitigate their damages. So once again, if a seller is selling to a buyer for $1,550, the buyer can't close. So then the buyer says, okay, I can't close. I'm going to offer you $1,400. If the seller says no, but then the seller sells for $1,200, they can sue for the full difference of $300,000. And the buyer can't say, well, I offered you $1,400. You failed to close with me. Now you resold for $1,200. So that's your fault. So no, it's not, because you guys signed an agreement of purchase and sale, both the seller and buyer for a particular price, and that contract is that contract. So the buyer can definitely request a price reduction. So every other transaction, we're having price reduction. Right? So the appraisal is coming lower and people are asking for a reduction in price. So we're always trying our best, and we're finding a lot of sellers are either Some of them are accepting it. We're negotiating and they are accepting because they don't want to go through the hassle of going to court. And a lot of them are doing what my dad was saying earlier, the vendor take back mortgage. So that's become a very popular option that I also recommend, right? But just so people are very clear, mitigation doesn't mean that, okay, my appraisal value came down, so the seller has to accept my lower price, otherwise I can't close. No, they don't have to. And the courts have also said in several cases that they don't have an obligation and they're not required to. They can definitely exercise, and the sellers do have to show that they did try, but they don't have to. Mitigation means that they have to show that they tried to accommodate, but that doesn't mean that they have to accept a lower price. Right? They can give you an extension, they can give you more time, they don't have to accept a lower price from a defaulting purchaser. So where does this leave us, right? So once again, just to summarize, mitigation means the level of effort used to resell the home, fair market value, failure to look at other options, but where does that leave us in terms of the current transaction, right? So as my dad actually mentioned a couple of points, right? Always, and Cunnin as well, always try to close a deal, even if it means arranging a private mortgage. A lot of times it's tough to convince clients. They don't want to pay that much in lender fees. They don't want to get the private mortgage and close. But if they don't close, they may pay, let's say, how much in like 20,000, 30,000 in lender fees plus interest. It's always better than not closing, defaulting an agreement, and risking getting sued for possibly hundreds and thousands of dollars, right? So always try to close a deal, always try to get a vendor take back mortgage if possible. And if you really can't, try to negotiate mutual release. So it comes to one of those things where we have to explain to the client, yes, you may lose a portion of your deposit, but you may be able to cover their carrying charges and sign a mutual release and go resell the property. And at least you're avoiding having an agreement that you've defaulted on. So one of the things that, like, since us as lawyers, we're always looking to put clauses into the agreement and do things to protect yourself, there are certain things that we recommend in practical terms. Like I talked to my dad about one of these clauses and he said no listing agent would do it. So I actually approached my dad the other day and I said, Dad, there's appraisal contingency clauses, which means that you can put, like, if you want to protect your buyer, especially buyers who have, they're very tight on finances, you can put an appraisal contingency clause that says that if the buyer has the right to walk away in the event the appraised value is lower than the agreed purchase price. Then my dad said, no listing agent is ever going to do that, Rashani. Like, they're not going to, in this day and age, with multiple offers and things like that, sellers are not going to do that. So I understand it from the real estate side of things, right? But in the legal sense, if you do have someone that is particularly picky, but of course that obviously that reduces their value when you put the offer, right, compared to firm offers. But they do exist, right? Appraisal contingency clauses do exist, right? So if you put that, because of course you can put whatever clauses you want into the agreement, but it means that, like, in the event that the appraised value does come lower than the agreed purchase price, or you can even put by more than a certain number, it gives the buyer the right to walk away. So of course that protects the buyer client. The sellers probably won't do it in any practical terms, but as a lawyer, it's important for us to just put it out there that that exists. But more importantly, and more in practical terms, as real estate agents, make sure you guys at the very beginning, when a client tells you, like, we want to buy a property, we want to purchase, make sure you guys are clearly explaining to them how appraisals actually work. We find that, like, so I had a client last week came to my office and he said, my appraisal came down. I didn't even know, like, I didn't properly understand appraisals. I just trusted the real estate agent and the mortgage broker. Now I have to come up with an extra $100,000 on my own. I want to sue them. I said, no, like, let's focus on closing the transaction first. Right? But what I want to tell you guys as agents is make sure clients clearly understand what an appraisal means, right? So an appraisal, right, is a professional opinion of the value of a particular property, right? It's an unbiased professional opinion, and make sure they understand that in the event that the appraised value comes lower, the lender is only going to lend on what the appraised value is. They're not going to care about the purchase price. So obviously, any shortfall in addition to their down payment is covered by, so my dad kind of can elaborate on this further, but it's going to be covered by the client. So make sure upfront they understand that, so that they don't come back to you later and say, you never told me this. I didn't know that. I thought I only had to cover my down payment. I never thought that I would have to cover any more than what my down payment was. Make sure they know, and make sure you guys are putting that part in writing. So obviously, when a client comes to you and they say that they want to purchase a property, or even when they want to sell, you guys discuss their finances up front, right? Make sure you guys are putting all of that in writing, because especially in these type of markets, when things are changing, appraisals are coming down, people are very quick to flip on you, basically, right? So when you have that in writing, you ensure that you don't become legally liable for anything, or in the event they go to court, they don't also vicariously sue you in addition to everything else. Because sometimes if the seller says lower and they sue the buyer, the first thing the buyer does is say, okay, I want to sue everybody else as well because I trusted everyone. And you guys I always feel that you guys should best protect yourselves by communicating very, very clearly to the clients, clearly explaining to them. If they even talk to a mortgage broker at the beginning first, that's also better. But especially when it comes to appraisals, just make sure you're clearly communicating what they are, how they work, put it in writing if you can. It's always a good recommendation, as well as the deposits on agreement of purchase and sales, right? So especially now that appraised values are coming down and people are having issues, in Ontario, as you guys all know, with a basic agreement of purchase and sale, a valid agreement of purchase and sale requires either 1, consideration, or 2, signing under seal. So all ORIA forms are drafted under seal. So this means that they're legally enforceable regardless of whether or not a deposit's given or what the deposit amount is. So whenever you go to court, nobody cares what your deposit amount is, unless it's so disproportionate to the purchase price that you're applying for relief or forfeiture. But aside from that, usually they don't care about what the deposit actually is. And a deposit is considered consideration. But even without a deposit, there's still a contract. So a lot of times people will say they'll sign an agreement of purchase and sale. And this is even for the regular market as well. So they'll sign an agreement of purchase and sale. And then if they want to back out after, or they signed a firm agreement and then they don't give the deposit, they say, okay, can I walk out of the deal? I don't want to give my deposit, then I'm not going to lose anything. No, that's not true. So even if you give the deposit or don't give the deposit, if you're in breach of the agreement, you're in default, right? So in the event that it's still a legally binding contract, with or without a deposit. So you're supposed to give the deposit, especially if it's contracted for, but they can still sue you. So they can sue you for the difference. They can sue you for the deposit you never submitted, because that deposit belongs to them. So we just have to make sure we're being clear in terms of what the actual rules are, what we're advising clients, and how we're protecting everybody. So I'm finding the biggest thing now is the deposits, the appraisals, the negotiations, the price reductions, but always tell your clients it is best to close the deal. Of course, it's difficult. There's some clients that are very adamant, and no matter what you say, I have a transaction right now where the purchaser, their appraisal came down, so they got an extension. They're purchasing from the sellers. Sellers also buying. There's 2 sets of conditions that came. I think at least 15,000 of penalties. My client said, I don't want to pay a single penny. So I just don't want to pay anything. In fact, I want to ask for 100,000 price reduction. So this is what's actually happening. And on our side, it's a negotiation between buyer and seller, but at the end of the day, we also have to always convince the clients, close the deal, because the ramifications of not doing so is a lot worse, especially when you go to court. It opens a big can of worms. You don't know how much they're going to sue you for. You don't know who they're going to end up suing. You don't know, they may flip and they may sue the agents, they may sue the lawyers, they may sue everyone. So to avoid all of that, as my dad said, right, if they're exercising the option for a vendor take-back mortgage, if they don't want to do a price reduction because they said they agreed to a certain price, then negotiate the vendor take-back mortgage. We're seeing, compared to about a month ago where people were just a little bit more adamant, and we find that sellers are a little bit more willing, especially in the last month, to do these vendor take-back mortgages and to negotiate a certain degree, because nobody wants to go to court, right? And then they're also factoring in, if they resell, they will resell for lower. So the hassle, rather than doing all that, it's still a profit to them. So a lot of them are doing abatements to a certain degree, but at the end of the day, as I said, sellers are not legally required to accept an abatement in the price, but for practical terms, we always try to negotiate it. But this is how the market is now. And if you guys have any questions about what I've been experiencing as well, I'm more than happy to share. There's so many stories. I think, to be honest, Hunter and my dad are probably seeing, we're getting daily calls saying that appraised value came down. What do we do?
Yeah, we're seeing that a lot. Thank you, Roshani. You really opened everyone's eyes with all these instances you're coming across. We do have several questions. I noticed that Celian's hand is up as well. And if Celian's asking a question, it's definitely going to be a good one. So Celian, if you want, you can go ahead. And then we have a few more in the chat box and a few other things that we'll bring up as well.
Yeah, I have a few questions. Somebody sent it to me. I will ask after that.
Okay. Perfect. Sally, and if you want to go ahead, you can go ahead.
Sure. Hello?
Yep.
So I know you did say, like, my question is against what everything you just said is, right? But like you said, you have to close the transaction, right? But I'm asking, like, is there cases where it's more strategic for the buyer not to do that? Because like the way things are plummeting so fast, if they just take the loss, isn't it better for some of them to just say, hey, okay, fine, goodbye?
So yeah, a client actually came, and I'll just be brutally honest. So a client came to us, he couldn't close. He said, Roshani, I have no assets, right? I have no assets. Can I just not close a deal? And if they come and sue me, I'm just going to file for bankruptcy, right? Like I have no money. So even if a worst case scenario, I go to court, I don't have any property, I don't have anything, I don't have any money. If I'm just going to declare bankruptcy and they can't come and collect, right? So in that situation, I always advise clients, like, that's an enforcement issue, right? So even if you take it as far as going to court, if they say, okay, you have to pay X amount in damages and you don't have the money, you don't have any property, you don't have any assets, declaring bankruptcy in and of itself, so my dad and Kannan can probably elaborate, also has ramifications on their own, right? Like when you declare bankruptcy, you can't do business for a long time. It affects you in multiple other ways as well, right? So it's always a give and take to the clients and what they're willing to give up, because if they go that route, right, and they just don't have the money and they just say, like, you know what, it's strategically better for me, like I'm going to lose X amount of dollars if I don't close, but if they sue me, I'm just going to declare bankruptcy. That in and of itself also has its own issues. So your client always has to weigh their options and speak to a litigator in the event that they want to do that.
So if they do get sued, right, is it only the difference between the new sale? So if say they sold it plus the fees and damages, right? But it's so we can know that it's going to be this amount of loss, right? But like what I'm saying is, like, based on what's happening, there can be a lot.
Charlie, you are absolutely wrong.
Right.
Okay. For example, you signed the agreement of purchase sale for 800,000. Appraisal came out maybe 760, and you didn't close the transaction. They closed it for 700,000. 100,000 difference. In your point of view and the mind, your mind thinking, whatever the price difference come, only they can sue. No, they already booked the ticket to Hong Kong for 10 people, $4,000 each. They wanted to go after the closing the transaction. And they have a chain closing. The chain closing, not only one closing. Sometimes the lawyers knows 5 deals are joined together as a one transaction. Then who is going to like look at the car accident? One car going to hit other car and the chain reaction. Who is the one responsible? The person who is in fault. They had to pay for the insurance going to cover for everybody's cost. Basically, Shalian, how much the lawsuit is going to be, no one control other than the judge. When you score the cost.
It's unlimited, exactly.
Yeah, okay.
The second thing, Shalian, you have to understand one thing. We studied real estate and come to I'm talking as a broker record, as a salesperson to close a transaction. I get the call from salespeople. They asking me if the buyer walk out from the transaction, what kind of lawsuit? Okay, for example, I know that's a good question, but at the same time, you studied real estate and you come to the industry and you paying the trap fees and everything, you making the transaction, and finally, what's happening in the market? Your buyer doesn't want to close it. You want to say yes answer or try. I just started with today the closing techniques for the appraised value come lower. We had to use all those one and close the transaction. Otherwise, you go with the empty hand and all this advice like a person who work in the temple. Okay, for example, we had to understand, we had to try to close the transaction. Every whatever happening, whatever you're seeing in the real estate industry is not the value. It's a paper money going up and down. Otherwise, there's no reason to come down 300,000 in 2 months' time and 300,000 in other 3 months' time. We had to explain to the clients whatever happening 3 months' time came down lower. This go back again in a year or two. That's the advice we had to give them. In our side, as a realtor, you had to think yourself first. You made an agreement, you signed the agreement, you had to close the transaction. Or the lawsuit and everything, that's not your hand. That depends on the chain transaction and depends on what exactly happening. Understand that part?
Yeah.
Okay.
It's unlimited. Just to add to what my dad said, it's completely unlimited. When they start to sue you, they can sue you for everything, not just the difference, but everything: carrying costs, legal fees, chain transactions, everything and anything that would have been into their damages. So as my dad said, so you don't want to end up in that scenario for your clients.
Shani, I have a question for you as a lawyer. I was thinking to call you yesterday and ask you this question. Finally, I get the time. It's good for 75 people are on board now. It is good for everybody. Okay. Yesterday we have a closing at the second mortgage. Then the client said who is the lawyer is one of the lawyer's name. And around 12 o'clock, our lender's lawyer call and say that buyer's lawyer is rejected and they're moving to another lawyer for the particular closing. You understand?
Yeah.
Okay, they make their purchase agreement and everything. They assign one lawyer as a buyer's lawyer. And the 12 o'clock yesterday, the lawyer said, I don't want to act for you. And they moving to other lawyer. Do you think the mortgage brokers can change around the lawyers that faster? And what are the legal obligation for the lawyers if they're going to take over the deal in the time? I know as a real estate broker, there's a clause called title search. Lawyers has to do the title search before that one. What is your opinion? What is your answer? Are you willing to take any deals in the last 3 hours ago?
Well, as lawyers, we obviously hate when people switch lawyers. So we obviously hate when we've done all the work on a file and they switch to a different lawyer. But in terms of the legal aspects for clients and brokers and things like that, what happens is the point of the agreement of purchase and sale is that they have the title search date, right? So you have, as a buyer, several rights with relation to title searches. So if a title search is completed by a lawyer prior to the title search date, we're able to detect any title issues on the property and we're able to rectify it prior to closing, right? So usually, like, the buyers are supposed to give the agreement of purchase and sale to a lawyer prior to the title search date, and we search the title to make sure there's no liens, no encumbrances, no title issues, no any other issues that affect titles to the property. What happens is, if we do this prior to the title search date, we're able to enforce these title issues to the vendor, right? And so we're able to say, so for example, if there's what's called a restrictive covenant on the property saying that several issues are involved and they have to rectify it before closing, if we do it before the title search date, we can demand that the seller's lawyer complete it. If these are done after, then we can't. That's the entire point of the title search. When mortgage agents switch lawyers for whatever reason, right? When they switch mortgage brokers and lawyers at the last minute, the risk to lawyers is that they don't have sufficient time to thoroughly check title. This can give rise to a lot of errors as well. And this can give rise to a lot of liability. So there are a lot of lawyers that take or don't take these deals, even when the previous lawyer forwards all the title searches and things like that. If there are title issues on the property, if there's a new lawyer, if we request that these amendments be made, the lawyer's going to say, no, you're doing your requisitions after the title search date. So it becomes a legal liability to the clients. And plus, like, closing in a short amount of time, depending on the bank and things like that, also pose other risks and risk for errors, missing things, and et cetera, et cetera. So it's always a risk, especially with relation to the title searches, for sure.
Thank you. Khanna, you continue the questions.
Perfect. We see Delano's hand is also up. So Delano, if you want to go ahead.
Hi, can you guys hear me? We're good?
Yep. Perfect.
Okay. So just a little remark, not so much as a question. This is just, we're in the middle of the storm, right? But we're not the only ones who are involved in this. We're not the only ones who are affected by this. So I wouldn't let anyone panic too much. I mean, there will be solutions that will come down the road, because this is a situation that was created by the increase of interest rates. So there is a period of observation. I mean, you will see the land transfer taxes going down significantly. There are more than your buyers or realtors who are going to be affected by this entire scenario. So there are going to be many solutions coming up in the next few months. I'm quite certain of that. So I don't think it's a time to panic and think, oh, you know what can I tell my buyer? There are solutions that are going to come up. There may be some solutions we haven't even heard of up to now. But, you know, the banks will work on it. There'll be packages. There'll be things coming out. There'll be promotions. So I wouldn't worry. I mean, it's time of concern, but it's not a time of ultimate despair. Just be patient. Things will come around, as they always have. This is not our first run on the rodeo, right? So bear with us. Yeah, no, that's definitely true. When it comes to the bank side, when it comes to products that they're coming out with, we already see banks on the B side, they're increasing their amortization to 35 years. We've only seen 25 and 30 years amortization for quite some time. Now, Community Trust came out with 35-year amortization a little less than a month ago to ease the qualifications under certain banks. And as you said, with products, yes, many more products are going to be coming out. CIBC is working on a self-employed product right now. I've heard rumors of RBC working on a self-employed product right now. So certain products will be coming out to assist with clients with the higher qualification mortgage stress test
that we have in place for mortgages to be approved. At the same time, right now, yes, everyone is tightening down, and based on off-cease policies and all the monetary policies in place, banks should stricten up their rules as well. But at the same time, they're going to be figuring out ways to circumvent those measures and also provide mortgages and approvals. At the end of the day, the banks are balance sheet lenders. If they have money, they have to lend it out as well, right? So eventually we'll come across that. But again, yeah, we are in the just the midst of the storm right now.
Delano, thank you for your comment, Delano. Plus, I wish every single real estate agent in our office should have the mindset as whatever Delano said right now. Something changing out is going to be back to the normal situation very soon. Plus, bank have money. What they're going to do if they don't lend out? They lose money. Finally, they go over bankruptcy their own. They create their own bankruptcy. Definitely, they will lend out the money. They will come up with the good programs. Thanks, Leano. Thanks for your very good comment and you sharing your mindset to everybody. Thank you. Karna, you continue the questions.
Perfect. Okay. We have another question here regarding, let me see, anything towards Rashani. Okay. If appraisal comes low, what is the best way to negotiate the price with the sellers? Is it best done through the lawyers, or if it's best done through the buyer's agent with the seller's agent? Of course, that depends on the timeline of when they're finding out about the appraisal. If the appraisal is done quite early, you know what, hey, Bashani, let me speak about the appraisal part when it comes to the mortgage qualification first, and then you can talk about how we can handle it after the fact. Within the mortgage broker world, or mortgage agent world, institutionally or even on the broker channel, appraisals right now is not the first thing that we do on a mortgage application. It used to be like that. Now, we're focusing on doing the appraisal first, even for a purchase. For refinances, we always do the appraisal first. Why? Because we know that the prices are coming down. There's no point sending in an application qualifying the client for a $1.2 million mortgage and the property being worth at a specific amount, and then finding out that the property value is much lower. We wouldn't want to do that. But for purchases, which is much more important, there's still a delay in the appraisal process. If as Rashani mentioned, you can put an appraisal clause on the APS. You can put any clause you want on the APS. But the difficulty of that, are the sellers going to accept it? And especially with still the competition we still have in the industry, are there going to be other buyers going in with a firm approval? Yes, right. We're still seeing that concept, right? Regardless of there being, certain transactions where there's still a lot of buyers buying just one property. Now, if you can, always urge your mortgage broker or mortgage agent to try doing the appraisal as soon as possible. When working with the purchase, even if it has a finance condition on it or not, I still try to push out the appraisal. On the broker side, you can send a request for an appraisal immediately. Now, even before you buy the property, we can send out an appraisal. There's no problem at all. But now the question here is if the appraisal will be done in time. For banks such as Scotiabank, when Scotia is doing a mortgage, it's usually Scotiabank's underwriter, the underwriter that you're dealing with, that sends out a link for the appraisal to be ordered. So that means from the day the mortgage broker gets the deal to the time it gets sent in to the lender, by the time the underwriter looks at the file, approves the file, and then now sends it to an appraiser or gives you the link for an appraiser, there's going to be at least a week to 2 weeks delay or a week to 3 weeks delay in that time frame. Depending on the other lenders that you're dealing with, if we're sending an application on the B side or A side with TD Bank or with any monoline lenders, you can order the appraisal right away. The client sits in front of you, they give you the APS, the agent is there explaining everything. You can order the appraisal right away. So within less than 5 days, usually less than 5 days, if you do a rush appraisal, you can get the valuation in your hand, which may help agents when it comes to negotiating the value of the property in the earlier terms of that contract that you just signed. Now, I'll leave it to Rashani that she can speak about the part where if the appraisal is found out last minute or even earlier during the contract.
So we're finding, so one client actually did this. So this happened on one file, and I found it to work pretty well. So in one of the files, the appraisal value actually came down by quite a bit. And the seller, the purchaser, the first thing they told us, and they said, can you ask the sellers, ask for a price reduction, but tell them, go do your own appraisal as well, right? Because sometimes some sellers are not quick to understand. They understand how it works, but they think maybe we like fudged the numbers or we used a company that's favorable to us. So the purchaser actually told us, okay, request the price abatement from the seller's lawyer, but then offer the sellers, go do your own appraisal as well. You can see for yourself that the value has actually come down. And this may help have the sellers understand what the current market value is at now and help negotiate a price reduction. But to answer your question, whether it's better to do it through the agents or through the lawyers, really depends on the relationship. It depends on the seller, it depends on the seller's realtor, and how cooperative all parties are and what their understanding is about the current market. So every file is different, every person is different. We find that some sellers are clearly aware, they understand how court works, they understand how what's happening in the market and their options. And I think it comes down to explanation. So if you find that the seller and the seller's realtor are relatively open-minded and they understand what's going on, and you think you can do it between yourselves, by all means, that's great. But there's a lot of times where that's not the case. Like we have several files where we're the purchaser and the sellers are so adamant. They said, no, I just want to go to court. I want to go to court. I don't even want to negotiate a vendor take-back mortgage. I think the seller was, I don't want to say any race here, but the seller was a particular person that just was not willing to do an abatement at all. And in those situations, it's good to go through the lawyers, because even when the seller's realtor has tried and can't get through to the seller, at least when they hear it from the lawyers who are going through so many files and have experience seeing what happens when these things go to litigation, then usually I find that they're a little bit more willing to listen. So it really depends on the open-mindedness of the seller and the seller's realtor and their understanding of what's going on.
Okay. Any other questions? Let's take a look here. Okay, question. If a person has been pre-approved for $1 million mortgage before the 1% rate hike on a variable rate, should that person go back to the bank for reassessment or not? Very good question, Shiraz. So in this case, you've been pre-approved for $1 million before the 1% rate hike. Now, the thing is, the 1% rate hike is going to be only increasing the interest rate that the client is obtaining. The qualifying rate is actually still going to be the same depending on the rate that they received. So that pre-approval should be fine. If it's a fixed term, then there might be a few changes. Either way, right now, almost all banks, other than the fact of if it's an insured deal, there's no requalification after an approval is given. But some banks are now, even after you get a firm approval, they are looking back at the rates, but none of them will be canceling that firm approval. So if you get a firm approval, you should be perfectly fine, even if the rates have gone up, the qualification portion. But if you have a variable rate, yes, even if you get a firm approval and the Bank of Canada's rate goes up, your interest rate is going to go up regardless. If you have a pre-approval, always go back to the lender and make sure, regardless of whatever your pre-approval says, go back to the lender and make sure that it's still qualified. Every bank is changing their policies into how it's being done. But remember, a pre-approval is nothing but a piece of paper, in my opinion. Pre-approval is nothing but a piece of paper. You could be approved through a pre-approval for $1 million mortgage, and then the bank is now stating that they have to pull your credit, yet they have to requalify you. You have to give them your, your 2-year average income and etc. Many things could change. So if you have a pre-approval, it's always best to anticipate that you're going to be requalified. But remember, the interest rate that you get is not what you're being qualified under. We have the stress test, which is at 5.25 right now, so you'll be qualified under that, depending on the institution that you're with. So a simple answer to your question, if it's a pre-approval, expect to get requalified. If you have a firm approval, it's firm.
I have a question.
Mm-hmm.
Can I finish the questions or just?
Yeah, we're done.
One agent sent me the question, as an active real estate agent, if I declare a bankruptcy, I may lose my license. This is the question. I get it right now. Maybe we talk about the real estate side. Somebody worried. Okay, the thing is just a no answer. What is bankruptcy means? You guys understand what is bankruptcy means? They just came to the country like Canada or the first world countries came out. If you borrow the money from different creditors, If you borrow the money from creditors and you cannot able to pay for the money back, and the creditors calling you and ask you to pay back, that's the torture and give you the stress. And finally, that may cause you to go for suicide. And stop going to the suicide and somebody torturing you. That's called a bankruptcy. Okay, but when you apply for the bankruptcy, because of the question I want to explain a little bit more deeper, because it's almost we're ending it now. Okay, but what that means is, you are going to when you apply for the bankruptcy, the people are qualified as a lawyers getting the license and chartered accountant get the license as a trustee in bankruptcy. And what they look at your application and see the application, how much money you are outstanding to owing the money to the creditors, and what kind of loans you have it already. Based on that one, based on your income and based on your asset, what kind of car you are driving it, up to $7,000 worth of car. I'm telling you based on my knowledge. I know there are some people who know much better for the Bankruptcy Act, but I'm just telling for the information purpose only. Then they look at the car. Your car is worth, you are driving the Lamborghini and you cannot go for bankruptcy. Your car is only they allow, based on my knowledge, up to $7,000. I'm talking about 2-3 years ago rules. And the house you are living there, they never going to sell. They were never going to ask you to sell the house. They were never going to ask you to sell the house and go for bankruptcy, because the shelter, they don't take out from the shelter, but still they look at the equity of the house. There are a lot of things are there. That's mean the trustee have the access to see whether you want to go for the proposal. If you are a high income person, they may ask you to go for proposal or bankruptcy. When they apply for the bankruptcies, for example, you may have 7 creditors already lining up, and CABC $20,000 and TD Bank $100,000 and Scotia Bank $50,000 and a few other things. They will look at it, and if the banks are agreed or the creditors are agreed, you are going for the legitimate bankruptcy. That's mean the loans accumulated for many years, rather than you went to the Home Depot and buy five washer and 5 dryer and bring the bill up. But then if they see it's a real loans and bankruptcies, yes, you can apply for the bankruptcy. In that case, after that one, what you had to do, RICO asking, I'm coming to the RICO side. RICO asking, disclose to me based on the nature of the bankruptcy. If the bankruptcy is involved for the corporation, if the bankruptcy is involved for the house, you bought the house, a real estate transaction, the house you buy and you don't pay the mortgage and give the house to the bank or something like that, real estate transaction, financial transaction, your personal side, they will go by case. I know one agent, he went to the bankruptcy, but he didn't lose the license. They will go through case by case and they allow, but the answer is yes and no. Who is the one going to decide? RICO registrar or representing the registrars representatives who are acting for the registrars, they had to decide. But in our side, we had to decline. If you are going with the bankruptcies, you had to inform them within 7 days. Anything happening in your life, you had to apply for 5 days, 5 to 7 days. I believe it's 5 days, 5 working days, or say 7 within 10 days you had to apply. I believe it's 5 days anyway. Then after all, what happening is based on RICO is not 100% you losing the license. That's all for today. Kana, you want to say anything to anybody?
No, I think all the questions we've gone through everything. There's a few questions regarding trigger rate. But you know, we're going to be discussing that next week as well. I just want to remind everyone. So next week we're going to have an RBC specialist come on board. He is an economist with RBC and within the wealth management space. His name is Manan, and he's going to be joining us next week, Saturday. And I'm just going to tell you the 2 main core topics he's going to be discussing. One is going to be, he's going to be talking about the importance and insights about the present macroeconomic environment. So including inflation, interest rates, state of the broader economy. He's going to be speaking about that within Canada and also globally as well. And also the current research data specific to the Toronto and GTA market when it comes to the real estate market. So we're going to be having an in-depth conversation next week. So definitely be on board for that. I think for this week, we had a pretty broad scope of the economy and what's happening within the real estate spectrum as well. But definitely next week, we're going to have an in-depth conversation. And Adnan, I know you spoke about trigger rate. I brought that question up as well, but we'll be bringing that up specifically next week as well. So stay tuned for that, guys.
Thank you, Kannada. Thank you so much, Kannada. Thank you so much, Kannada. You are arranging different people's different industry specialists to our group to give us the knowledge, including our home life lawyer. Thank you, Rishani. Thank you for the information. Thank you, Kannada. Okay, we are excited to see you next class, next Saturday morning. Okay, thank you.
Thank you, everyone. If any of you ever have any questions directed specifically towards me, please don't hesitate to send an email. Or a phone call. I'm always happy to answer it. Thank you, everyone.
All right, take care.